Maya did everything she was taught. She saved 6 months of expenses, kept it in a trusted savings account, checked the balance every Sunday, and felt proud every time. Last year, her bank paid her $76. That same year, her bank used her money to earn over $1,200. She thanked them for it. Here's the system she never knew she was inside. Maya is not alone. And the number is not the point. The point is that almost everyone watching has money sitting somewhere earning only a fraction of what that money is actually generating. The bank keeps the rest. And the system is built so you rarely stop to do the math. By the end of this video, you'll understand how it works, what the spread costs over time, and what Maya's friend Jordan thought he figured out, and why he was only half right. Meet Jordan. 2 years ago, Jordan heard about high-yield savings accounts. He moved his money, now he earns 4.5% instead of 0.38%. That is roughly 10 times what Maya earns, and he talks about it like he discovered something most people missed. He even sent friends links to open their own accounts. Jordan feels smart, Maya feels safe, both feel like they made reasonable financial decisions. Neither has asked the question that actually matters. The moment you deposit money into a bank, that money stops being yours in any meaningful operational sense. It becomes inventory. The bank takes that deposit and puts it to work. It flows into mortgage loans, auto loans, credit card debt, government securities, commercial real estate, and business lines of credit. The bank sits in the middle, borrowing cheap from depositors, lending expensive to borrowers, and collecting the spread on every dollar. This is not a secret. It is just not something banks advertise. The technical term for what they keep is net interest margin, the gap between what they pay you and what they charge everyone else. For the largest retail banks, that margin has averaged between 2.5% and 3.5% for decades. In 2023, many ran north of that. So when Maya deposits $20,000 and earns 0.38%, her bank pays her $76 a year. Meanwhile, it can lend that same $20,000 at rates between 7% and 21% depending on the product. Even blended conservatively, the bank clears $600 or more from her deposit. $76 to Maya, $600 plus to the bank from the same money. This is where it gets interesting. Jordan is beating Maya. That part is true. But look at what Jordan's bank is doing with his money. His bank pays him 4.5%. Banks don't do that out of generosity. They do it because the current rate environment lets them earn more than 4.5% on the money they lend or park elsewhere. A basic 30-year mortgage is around 7%. Auto loans average about 7.5%. Credit cards charge average APRs above 21%. And U.S. Treasury bills, which banks can buy with essentially no credit risk, yield around 5%. So Jordan's bank can pay him 4.5% and still earn 5% on treasuries alone. That's a spread. On loans, the spread is much wider. Jordan didn't escape the system. He got a better deal inside it. There's a difference. Here's the part most people were never told. When your bank runs out of better yielding loans to make, it parks money in U.S. Treasury bills. Treasury bills are short-term loans to the federal government. They're as safe as deposits, arguably safer because they're backed directly by the U.S. government and not exposed to bank failure. They currently yield around 5%, and you can buy them yourself. Directly. No bank required. You can use treasurydirect.gov, a brokerage account in a few minutes, or a Treasury ETF inside your existing investment account. Your bank is acting as a middleman between you and the U.S. government. It buys the Treasury bill with your money, collects 5%, pays you 0.38% or 4.5%, depending on how loud you complained, and keeps the rest. That can be 3% for sitting between you and a transaction you could complete yourself. Now the math. $20,000, 20 years, no additional contributions. Maya, at 0.38%, grows to about $21,520, earning roughly $1,520. With inflation around 2.5% annually, she didn't grow in real terms, she fell behind. Jordan, at 4.5%, reaches about $48,140, earning roughly $28,000. But his rate is variable. When the Fed cuts, it can disappear, just like high-yield accounts did from 2009 to 2022 when many paid 0.5% or less. There are no guarantees. SGOV is an ETF that holds short-term treasury bills and passes the yield directly to you, currently yielding around 5.1% with no state income tax on the interest in most states. No middleman. The rate tracks the actual government rate transparently, not whatever a bank decides to pass through. Maya has $20,000 in a traditional bank savings account. It feels safe, it feels responsible, And, to be fair, it is not doing nothing. But here is the part most people never calculate. The bank may be earning much more on Maya's cash than Maya is. A short-term treasury fund like SGOV holds very short-term US Treasury bills, so its yield moves with short-term rates. It is not a bank account, it is not FDIC insured, and the price can move slightly. But it makes the comparison clear. If cash earns around 4% over a long cycle, $20,000 can compound into roughly the low 40,000s before personal taxes and fees. If Maya's bank pays far less, the missing money does not vanish. It becomes part of the bank's spread. And that spread is only one revenue line. There are overdraft fees. Spending a few dollars more than the account balance can trigger a fee that feels wildly out of proportion. There are interchange fees. When you use a debit card, the merchant may pay a fee, and part of that economics can flow through the banking system. You bought the groceries. The payment network got paid too. There is float. When money moves between accounts, checks, transfers, and settlements, timing matters. A day here and there can create value at scale. There is data. Your deposits, bills, spending patterns, and recurring purchases are useful. Even aggregated or anonymized, financial behavior can become a product. Now, this is not a cartoon villain story. Banks provide real services. FDIC insurance protects eligible deposits up to $250,000 per depositor, per insured bank, per ownership category. That matters. Banks maintain payment rails, debit cards, wires, ATMs, mobile apps, fraud systems, disputes, support, and emergency access to money. Convenience has value. Safety has value. Infrastructure has value. The problem is not that banks make money. The problem is that the price is often hidden. If banks clearly showed the trade-off between convenience, insurance, simplicity, and treasury-based alternatives, customers could choose with open eyes. That is the real ask. Not panic, not blame, not one-size-fits-all advice. Just transparency. Because your cash is working every day. Maya and Jordan both made choices inside a system built to minimize what they get and maximize what the bank keeps. Maya made the default choice. Jordan made a better choice. Neither one made the most informed choice. The system wasn't built by bad people. It was built by rational ones, optimizing for their shareholders the way every business does. The rate they pay you is exactly as low as they think they can get away with before you leave. For decades, they could get away with close to zero, and most people just stayed. The information to make a better decision has always been there. Treasury rates are public, FDIC limits are published, net interest margins are in every bank's quarterly earnings report. None of it is secret. It was just never explained to you in one place, in plain language, in a way that made the math impossible to ignore. $20,000, 20 years, over $22,000 in difference. From choosing a different container for the same money? Next week, we go inside the car dealership. 14 separate profit layers built into every single transaction. Most of them activate before you sit down to negotiate. Prepared buyers walk in thinking they know the game and still leave having funded at least 6 of them without realizing it. If you don't want to miss that one, subscribe now. And if someone you know has money sitting in a big bank savings account, earning under 0.5%, send them this video. It's the most useful thing they'll see this week.